Hello friends. Last week in my video, I told you that the markets were betting on a clear mandate and I followed it up with my article in the Live Mint, which is India's first and only media column to offer you statistical inputs. Now, I said the markets were expecting a clear kind of a victory for any one side, not a hung parliament. And in this week's video, I want to follow it up with whether the big money, the smart money, guys who know something more than what we retail traders know, are they betting on continuity, which is the BJP victory? Now, this is a viewpoint I share with you based purely on data, which is what I look at in the market. I am not a trained psephologist or an election analyst. I do not have any leanings toward any political party. I'm a neutral, I'm agnostic, and I speak as a trader whose only interest is in the market. Now, these kind of findings based on data, I will share with you as we go along in each study. So please watch the entire video carefully. Rather than record a full segment, I've basically scattered it across the video itself. So let's dive right in, and on your screen right now is the weekly market roundup window, and what we are seeing is that the broader based Nifty 50 led the rally and the Bank Nifty followed suit. Now this is something that is off the beaten track which we have seen recently. I've been telling you why the Bank Nifty is important to watch, because the banking and financial sector stocks have 34.29% weightage in the Nifty, and how you can't have a broad-based rally unless banking and financial sector move up. So it's very interesting to note that the banking sector was lagging. The US dollar index, the Dixie, gained 25 bips, and that basically exerted downward pressure on crude oil and natural gas, which I have been telling you that I do not share a super cycle hypothesis. Gold and silver also witnessed some profit taking, which was along expected lines. Let's not forget the humongous rally that we've seen in the last couple of weeks. The Indian rupee basically gained against the US dollar because the USD INR fell, and the Indian 10-year benchmark bond yields fell, which means bond prices rose, and that was one of the reasons why the Bank Nifty went up. Do remember, on Wednesday, the RBI announced a humongous payout of 2.11 trillion rupees. And I've recorded a special video, which you can see in the hyperlink to that video, which you can see in the pinned comment below this video, as well as the description, as to what you can expect for banking, interest rate sensitives, and other corporate sectors. So don't miss that video, please. The NSE market capitalization rose a little over 2.25%, which means the rally was fairly broad-based. MWPL continued to surge to record highs at 43.44. These are levels I haven't seen for years. That means big money continued to bet more and more, increasing amounts of stakes they are raising in the market, in the F&O space, thereby betting that markets will not witness surprise shocks. Where the US markets are concerned, the headline Dow Jones Industrial Average witnessed some amount of profit taking, but the technology-laden Nasdaq and the broad-based S&P 500 continued to gain, which provided somewhat of a mild feel-good factor to our markets as well. Now, friends, at the inset box, let's see what happened of the performance, relative performance of the Nifty versus the Bank Nifty. Over a 4-week period, the Nifty continues to outperform the Bank Nifty. Over a 12-week period, it is the Bank Nifty which has generated mildly higher returns. But over a 20-week period, note how the Bank Nifty has hugely underperformed the Nifty 50. Now, if you were to compute the cost of carry, now these are spot index levels. If you were to calculate cost of carry, etc., the Bank Nifty has actually generated negative returns. So 34.29% weightage in the market is not doing very well. Friends, I now come to our in-house indicators. I start with the market-wide position limits or the MWPL. This is the extent of exposure utilized by traders as a component of what is allowed by SEBI. Do note how the MWPL has risen to 43.44%, which we've not seen for years. That tells me that big money, smart money, savvy traders are building up positions ahead of the election results to be announced on 4th of June. Why are they taking such exaggeratedly high risks? Are they expecting the markets to give a clear mandate to the BJP? It would appear so. Now, does it necessarily mean that it's going to come about? I don't have a clue. I will very readily admit that I am not a psephologist or an election analyst. So, what I am going by is the fact that market men are nursing a great deal of hope. You know, every once in a while you receive some gyan or some pearls of wisdom in your good morning WhatsApp messages that seem to be so prolific in the social media domain. Once every couple of months, I get this message: don't tell me what you feel about me. I will gauge your feelings towards me by your actions vis-a-vis me. Now, actions mean more than words. This is something that you and I know. And actions of smart money tells me that they are betting bigger and bigger amounts and carrying that amount forward, carrying that exposure forward. This is one big indication that big money seems to be confident. Is that it? No, I have more to tell you, so please stay with me till the end of this video. Now for stock and index futures turnover, these are cumulative 3 expiries. So it's May, June and July. What you are seeing is that a traded turnover was kind of flat in stock futures, marginally higher, very, very marginally higher. But in the index futures, the turnover was sharply lower. That tells me that a rollover activity hasn't started in earnest. Had rollovers started in earnest, you would have seen turnover go up because people would have squared up May and started initiating that exposure in June. Now for the advanced decline ratio, after the price, the advanced decline ratio itself is a leading indicator of the undertone. Do note that this is the average of all 4 trading sessions of the week rather than an absolute number. The average smoothens out the data. Now the Nifty managed to log 2.19% gains on a week-on-week basis, but the advanced decline ratio has come down to less than half at 0.78 as compared to 1.67 of the prior week. It tells you that for every 100 losers, there were only 78 gainers. Now the advanced decline ratio is a benchmark of one Marshmallow traders. Don't worry about anything. The Marshmallow theory is explained in a video. The hyperlink to it is in the pinned comment and in the description below this video. So these weaker hands, one Marshmallow traders, seem to be playing cautious. Not surprising. Do remember, we have election results coming up. Friends, I now come to the basis. What is basis? It's the futures premium or discount prevalent vis-a-vis spot. Just like options premium, the futures premium tends to contract ahead of expiry. Now, what you saw was that the basis for the Nifty more than doubled. Why did it double? Because short covering was seen at lower levels, which is why the premium went up. On the other hand, the red color line shows you the Bank Nifty basis. It seems to have come down marginally, which means as time progresses, the premium that traders were willing to pay was smaller and they seem to have booked profits a little bit. That was reflected by Bank Nifty's underperformance vis-a-vis the Nifty 50. Now friends, the impetus. Impetus is our exclusive in-house indicator you won't find anywhere on the internet. It measures the momentum. You've basically relied on it for almost 4 years now. Now the impetus for both indices has gone up with the price. That means the momentum was higher. But look at the relative comparison. The momentum was sharply higher in the Nifty whereas the Bank Nifty's momentum was relatively speaking milder. So that was reflected again in the gains that you saw in percentage terms of both these indices. I want both the indices to go up with higher momentum, which would tell me that the rally is sustainable. Otherwise, it could be a little faltering or a slowing kind of a momentum. It would run out of steam at a future date. Now, friends, for another exclusive in-house indicator, lift, weight, thrust, drag indicator. You won't find it anywhere on the internet. It's an exclusive in-house indicator. It stood the test of time for over 3 years now, and you've relied on it. It's performed very beautifully. What we have seen is that the Nifty's gains have been bigger over the prior week, but the lift, weight, thrust, drag indicator, which is a weekly chart here, has come down to minus 0.08. That tells you that at higher levels, the LWTD indicator seems to tell us that fresh buying support may be, relatively speaking, weaker. Can short covering come? Yes, of course, short covering can come. Do remember, it's an expiry week ahead. And in the expiry week, longs normally tend to get carried over more than shorts. So shorts tend to get covered. So short covering can come, but due to expiry and due to the impending election results, fresh buying may just be a little milder. Friends, these are weekly charts because it's a weekly outlook video. The daily statistics are uploaded on my social media channels, especially on my free Telegram channel, where things are always updated first. And I share all my thoughts there first. Friends, the in-house indicators done, I now come to the bond market, which has been the bellwether as far as I'm concerned, because the bond market is the fountainhead of money supply that fuels the prices of all other asset classes. Do look at the weekly chart on your screen, where the Indian 10-year benchmark bond yield has come down to levels of May of 2023. We are near 12-month lows, which means bond prices have shot up significantly. Now, if bond prices have shot up significantly, would the NAVs of gilt funds be far behind? No. The NAVs of these gilt funds are also higher. So, have we missed the boat? Have we missed the bus in having got out of gilt funds a little too early? Perhaps some of my online family members may be thinking so. I have specifically clarified this aspect in this video above. You can please refer to the hyperlink in the description and in the pinned comment below this video as to why I think even though the gilt fund NAVs have shot up after we've sold at a profit, of course, I don't think we've really lost anything significant. So I will, of course, update my Telegram channel first, foremost, and always as to what we must do with our fixed income basket. We are in a sweet spot. We've locked in due to laddering since end of 2021, the Indian 10-year sovereign benchmark bond yields. We've dabbled in gilt funds. We've got the sovereign guaranteed post office and senior citizen schemes, etc., lock, stock and barrel. So our fixed income portfolio ought to be doing good. But better times are ahead. I'm convinced of that. Friends, the bond market's done. I now come to the Bank Nifty, which underperformed the Nifty 50 relatively speaking. And the daily chart on your screen tells us that the index rose on 3 out of 4 trading sessions, thereby notching up gains of 1.78%. Wednesday was the only losing day, and the low of Wednesday was never tested again. The record RBI payout of 2.11 trillion rupees on Wednesday saw the Bank Nifty zoom exactly as I had predicted in a Wednesday night special video podcast. And the same video is available as a hyperlink in my description and the pinned comment below. Now, the weightage of this sector boosted the Nifty as well. The weekly chart on your screen tells you that last week we saw the Bank Nifty notch up a bullish candle that is still to overcome the bearish red candle, which was a power candle due to its sheer size of a fortnight ago. Now, the fortnight ago bearish power candle high is at 49,253. Once bulls are able to push the Bank Nifty above 49,253 on a sustained closing basis, you will see further upsides come in, A, due to fresh buying, B, due to short covering. Do note that the Bank Nifty is not yet at a new all-time high, unlike the Nifty 50, which is why I say it's underperforming. Friends, in the week before last, the Bank Nifty was placed at number 6 on our most volatile counters list based on statistical beta rankings that I maintain in-house. It rose 2 notches to number 4 last week, which means volatility went up. Not a very good sign because challenge levels also go up. Last week, I advocated an estimated range between 49,525 on the upside and 46,700 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I estimate a range between 50,400 on the upside and 47,550 on the downside. Please also monitor our daily, weekly and monthly pivots on our free Telegram channel. That will help you a kind of laser precise estimates of intraday, weekly, swing and buy and hold trades as well, available only on our free Telegram channel. So friends, like I said earlier, if at all the rally is to sustain, it is of paramount importance that the Bank Nifty participate in the rally because of the huge weightage that it enjoys in the Nifty 50 itself. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained 2.19% last week. And as the daily chart on your screen tells you, it rose on all 4 trading sessions last week. The breakout above 22,800 significant high, which I have been writing about in my live mint column and mentioning in my videos since a couple of weeks, was finally achieved with convincing volumes and a sustained close above it. That level happens to be a double top, and once the double top was overcome, bulls were firmly in the driver's seat. The blue trend line that I pointed out as a multiple support level has held, and how? It's basically stood the test of time, and now it's an established and accepted support in place. Staying above the 22,800 level remains the criteria for the momentum to build upon from where we are currently at all-time highs. And should the bulls manage to keep the Nifty above 22,800, short covering itself can take it up further. The weekly chart on your screen shows a power candle which has taken the index to an all-time high ahead of the Bank Nifty. The fact that the Bank Nifty is underperforming the Nifty 50 is sowing the seeds for future profit taking in the Bank Nifty. But that comes at a later date. The weekly low on the Nifty of 22,404 must be defended by bulls in case of any dips if the short-term momentum is to sustain. Friends, in the week before last, this index was number 15 on our most volatile counters list based on statistical beta rankings that we maintain in-house. It jumped by 5 notches to close at number 10. So, challenge levels went up a little. Last week, I estimated ranges between 23,000 on the upside and 21,950 on the downside. Do note that the high made was 23,026. That is a mere 26 points higher than what I estimated. In the coming week, I estimate a range between 23,500 on the upside and 22,425 on the downside. Also, please check our daily, weekly and monthly pivots, therefore, to pinpoint your trades even more precisely. Friends, being an expiry week, I remind you, you must exercise your stop losses diligently. You must put them in place and preferably trade light. Friends, I now come to the last bit of statistical analysis wherein I share the retail risk appetite of traders by way of the turnover contributed in the four segments. Now, in the index futures turnover, it rose by 0.03%, shown as a blue line, and stock futures turnover rose by 0.27%, which is indicated as a red line. That tells you that risk appetite, as shown by FNO traders, was higher. Where index options are concerned, the turnover contribution fell by 1.56% and stock options turnover went up by 1.25%. It is shown as a purple line. This basically tells me that the risk appetite was clearly higher. That means there was participation by smart money. In FNO, you can't really have too much of dumb money coming in because of the contract size, the span margin required, and the mark-to-market payments required. So it has to be big, powerful hands. Now, these big, powerful hands are showing increased risk appetite. Is there a possibility of there being a negative surprise for them? Hey, yes. We've seen before how elections can be quite unpredictable, and therefore nobody can be very, very sure about whether markets are going to go up or go down on election day, and whether A particular party is going to win or B particular party is going to lose. These are things beyond our control. We can only guesstimate based on the footsteps taken by smart money in the digital domain of electronic markets. Where are they putting their money? Are they showing higher aggression? Are they showing lower aggression? So what is being indicated by the FNO space is that yes, MWPL is going up and their exposure is being hedged in the option space. Do remember, I've been telling you since many weeks now, please put in tail risk hedges or hacienda hedges. The narration of the hacienda hedge is in the pinned comment and the description below this video. Friends, I now come to my own trading strategy in the week ahead. My tail risk hedges will remain in place because I think volatility is going to rise even further. My focus will remain on public sector units, and of these public sector units, specifically in the oil marketing companies, energy and power sector. The reason being that these are showing outsized price ranges, very high market-wide position limits. That means concentration of emotions and financial commitment. This is where price volatility will be the highest. Do also note that in view of the higher volatility likely, SEBI has modified the intraday price limits and circuit limits of FNO stocks. The link to that is also in the description and pinned comment below this video. I expect profit taking in industrial metals, and the profit taking will probably also make the metal mining company stock prices also a little more volatile. Copper and aluminium are basically witnessing the highest amount of volatility amongst the five metals that are listed on the multi-commodity exchange. And do remember, there is month-end usual volatility that comes in the commodity markets. Bullion may witness some more consolidation after a huge rally in the recent weeks. I would not take it amiss if the price was to fall a little more, but the overall broader picture remains positive. And sharp falls are likely to witness buying support coming in from strong institutional players. Now for oil and gas. Friends, gas price witnessed profit taking after having run up in the recent weeks, and Thursday and Friday, exactly these 2 days, exposed the soft underbelly of the oil and gas bulls. That they were jumping with joy about prices running up, but they don't really seem to be convinced. This is along expected lines. I've recorded that special video on oil and gas, the hyperlink which is in the description and in the pinned comment below. Oil prices too are witnessing some amount of profit taking in the near term at higher levels. So that presents theta decay opportunities for a discerning, savvy trader with somewhat deep pockets. I hope you've watched that special oil and gas video. Now, it's the kind of stuff that you will never ever get on the mainstream media or advisory websites, because it's a 360-degree worldview that we real world traders take and share with real world traders. Your feedback on my video is absolutely welcome. And yes, many of my online family have requested that these kind of videos need to be uploaded more often. I will be doing so remain assured about that. Friends, as the volatility rises, as the election result date approaches, I will be trading on smaller and smaller trade bet size. I'll be diligent about keeping my stop losses and tail risk hedges in place. Fresh ideas, if any, will be shared on my free Telegram channel, first, foremost, and always. Do take the effort to join me there. Friends, before I sign off from this video, a reminder to subscribe to this YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment below, do let me know how my videos are helping you become better traders. A request, please share my video with all your online friends and family and social media groups so I can reach out to smarter traders like yourselves and broaden my reach. I thank you for your patience and being with me in this video till we meet again in my next. This is Vijay Bambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.